We're live and it's Real Talk on Real Estate. And today we're talking about how the stock market crash last week affects the real estate market. And as most people don't realize, I know the news always makes a big stink about everything that happens on the open market. And so when the mainstream media makes things a big deal, we as people make things a big deal. And a lot of times what they make a big stink about is only for your viewership. And so it's not as much of an alarm as it would be if it was a long-term turn in the market. But it was a very monetary turn in the market. And in less than 48 hours, 3/4 of what crashed less than 10 days ago actually revitalized in less than 48 hours. So hence, the market didn't get affected immensely. But let me tell you, okay, because I'm going to explain to you guys how this truly does affect the real estate market when the market does crash. You got to pay attention to this because there's some unforeseen variables that are happening right now economically that stocks can affect where the real estate market goes. Now, there's positives, negatives, and there's different attributes to this. And so I want to make sure that we kind of hit that for you guys so that you understand as you watch the real estate market, what you should be paying attention to in the real estate sector when the stocks are getting hit and annihilated. So if you guys don't know, I invest in stocks and most real estate people don't. But the reason I invest in stocks is different from most people that invest in stocks. I only invest in large blue chip companies and large blue chip stocks, and they have to be dividend paying. And so one of the big reasons that I invest in stocks is because I double down, I ante my money twice, and I'm able to double down on my money, and then my money earns me cash in return two different ways from the stock market. And because of one of the ways is a direct correlation of what I do in real estate. Okay. And so let me explain to you guys before I even get started this. That way you guys kind of know the presence of why I even pay attention to this, why it's so important in the real estate sector, and why you should be paying attention to the stock market. I double leverage it. Okay. Now you have to either be really knowledgeable in stocks. I day traded back in the 1990s. I used to do it off a Nextel phone, believe it or not. It was all digital service. And I would sit there trying to pound my trades out in the morning at 7 a.m. Mountain Time, because that's where I lived at the time. And I was trying to day trade. Now, in 2001, when the stock market actually took a beating, was March of 2002. So 9/11 hit. The stock market took a monetary hit, but really didn't get affected until the following March. And now the following March, moving into April, the stock market got annihilated. I lost over $160,000 in less than 30 days because I was selling on margin. And the stock market, when you sell on margin, they start doing forced sales on you when you when you purchase stocks and you're day trading, whether you're trading short or you're trading for ups in the market or downs, you're trading short or you're doing regular trades. And so at that point in time, I said, okay, it's time for me to invest in hiring a broker. Okay, I'm just too busy. I had too much stuff going on. I was trying to play too many cards. So I landed up with a gentleman. His name was Dave. Dave is a great guy. Dave's been a friend of mine since 2002. When I onboarded him, I used to use another gentleman named Ed Hollis, and Ed was really good, but he just kind of moonlighted somewhere else and disappeared. As good of as a stockbroker as he was, Dave is still my broker to date. And here's what Dave and I talk about, and this is what you guys need to pay attention to. So for real estate investing, one of the most important things you can do is have liquidity. But it sucks to have liquidity because money in the bank is absolutely freaking worthless. And then if your money's not working for you, again, your money's absolutely worthless. And so I have my money tied up in real estate, and I have an exponential amount of money. Like I have so much money tied up in real estate. The vast majority of my net worth is tied up in real estate holdings, either long-term holdings, land, multifamily, retail, warehouses. But a vast majority of probably 80 some odd percent of my holdings are in real estate and actively in real estate. So don't take the vast majority of it. If real estate's your game, and by you watching this channel, I know that real estate either is your game or it's a game that you want to be your full-time game. And so I take about maybe 15%, 10% of what I generate in capital and I invest in the stock market. And over the course of time, we've invested millions of dollars into the stock market. Now, again, we only do big blue chip stocks, and they have to be dividend paying. So big blue chip stocks, like stuff like Walmart, stuff like Johnson and Johnson, stuff like Boeing, stuff like GMC, companies like ExxonMobil. Those are the type of companies that we buy. We look at big, we look at big pharma companies, pharmaceuticals. We look at stuff in the medical sector, plastics that are surgical implants, stuff that services the baby boomers in the health industry. So those are things that we pay attention to. We also do invest in transportation because transportation is big. So not only do we do oil like ExxonMobil and these guys that pay dividends, but we invest in the pipelines because pipelines are a transport system. So we invest in that type of stuff as well. Now, there's other stuff, and I can go on all day about the different stocks that we own and why we own those. But the whole key component here, guys, is that I only purchase dividend-paying stocks. And when they pay out their largest dividend, like ExxonMobil, when COVID hit, they started paying out a 6% dividend. Then, like less than 2-3 weeks later, they start paying like an 8% dividend. So I purchased as much as I could as they were paying out these 8% dividends, and we were getting 6% dividends. Now, the difference between the dividends and the return on your investment is different, because your ROI, your return on your internal rate of return, your investment as it sits. If you buy 1,000 shares of something and that stock goes up, then you get to ride that stock on its way up. When you have dividends, not only do you ride that stock on the way up, but you also make money on your dividends, whether the stock goes up or down. And there's volatility in the market based on your initial investment and your stock holdings and the amount of shares you have. You get paid a dividends on that, whether the stocks go up or down. So I love that. And so no matter what, most of the stocks that we have, the minimum dividends we get paid is 2%. It has to be a very strong company. And we get paid as high as 8%. Now, most of them fall between 4 and 6% is most of the dividends. Now, the reason I'm telling you this is because it's an exact correlation to the real estate market and what we do in the real estate market. Now, what I do is, on average, since 2002 to today, on average, we make right between 11 and 12% annually on our stocks. Now, with that said, there's been years that we've made 0%, very few, but just after the 2008 recession, there was one year that we made, I think, like 0%. Like we made almost nothing. It was like less than 1%. And then there's been other years that we make in excess of 20 some odd percent. And it just really depends on how the stock market is doing at that point in time. So it's the long game, right? It's the long game. You don't want to pay attention to your stocks every single day, although it's fun to look at them monthly, right? I get my monthly statement, I look at them, and like this month, I'm like, oh, cool, man. My stocks went up $100 and some thousand for the month. Not a bad month, right? But to next month, it might go down $100,000, right? So there's this volatility game, but over the course of time, this volatility game, they consistently go up, and that's the goal. And so when you play this game and you're investing in real estate, your money's working for you in the stock market. We're investing in safe companies. And does that mean we've never lost money? No, we've lost some money in the stock market, but very little. Most of it is all been upward gains. And like I said, our annual average over the course of time has been between 11 and 12% annually. And the reason I tell you that number is because in times like today where money and lending is super expensive, I'll tell you how we utilize this in our benefit to execute and purchase real estate. And then I'll tell you how the stock market actually gets affected, how real estate actually gets affected by the stock market. Now, what we do is I can borrow against my money when interest rates are really good. My money to borrow against my own money only cost me about 5%. Now that interest rates suck, my money to borrow against it costs me about 7% annually to borrow against my own money. Now, as I borrow against my own money, I'm not selling my stocks. I keep my stocks. All my stocks are still working. All my dividends are still getting paid, everything. I just take a loan against my portfolio. It can go up to millions of dollars, and you get capped at usually about 75% of your portfolio. So I can take millions of dollars out at any given time within 24 hours, and I can just write a check for a piece of land or for a down payment for a project. But I never write a check out of that account that I can't replenish that account with, because you don't want to keep that money out of that account for a long duration of time. So if I know that cash is coming in from another project and I need cash today and I need a large amount, instead of raising it from investors, I can go in, I can write a check for it, boom, put it against my stocks. I'm making 12%. They're charging me 7%. And so I'm still making somewhere between a 4 and 5% spread on my money. So my money that's in the stock market, in spite of me utilizing it, I'm still making between 4 and 5% spread on my money, and my money in the stock market still earning me returns. Okay, and that's why we do it. And so, and plus, I keep my liquidity, but my money's still at work. Two different ways. One in real estate and one in the stock market. And so we always constantly have that movement. Now, when we talk about this, when stocks get hit and they get plummeted, it does affect the real estate market. And when it goes for a long duration of time, it affects consumer confidence, right? Because people are going, oh my God, there's like chaos in the market. And so they delay purchases and they slow down. Merchants slow down because of the delayed purchases that people make based on stocks. A lot of people with fixed incomes, 401ks, IRAs, and even just regular stocks, they get affected when the market actually turns. And so they get scared. Even if it's monetary, they get scared and they withdraw from the market and they hold because they want to make sure that their returns are solid and that they're not frivolously spending against the stocks that may be volatile at that moment in time. So that's one thing, okay? Now there's a total of 5 things. I'm gonna go over all 5. Number 2 is interest rates. Now, typically, the market tanking is a good thing for real estate because a lot of times what the central banks do is they go in and they say, well, the stock market is being affected. We got to control the economy. If we lower interest rates, consumer confidence goes back up, spending goes back up. And so there's this exact correlation of the stock market dropping and interest rates going down in conjunction with it. Now, unfortunately, the stock market has not been affected long enough for that to happen to interest rates, or we would have already seen these interest rate reductions, and it hasn't been a variable with interest rate reductions in the current market. So in spite of the stock market taking a beating less than 2 weeks ago and our economy slightly being affected mentally from mainstream media, it didn't really affect the overall economics of what's going on today. Although historically, when we see stocks slowly drop, it's a good indication that also interest rates will drop along with it. Okay, and that's just to increase consumer confidence and get people spending money again. Investors' behaviors when this happens and the stock market goes crazy is that they contract, right? And when they contract, they get scared to keep all of their money in the stock market, which I never encourage everybody to put all their money in one type of investment, much less one investment. And so consumers start to diversify their portfolio. So this is good for the real estate market because now people draw from their funds from stocks and they actually start investing in real estate. And when they do that, it helps stimulate the economy in the real estate sector. So usually when stocks go down, real estate kind of goes up. When real estate goes up and stocks go up with it, then they kind of plateau each other and they kind of ride this teeter-totter effect, right? But when stocks go down, real estate typically goes up as far as value, okay? Now, that's not all the time, but when we see long-term reductions in the stock market, that is the case. And so pay attention to that. That's important. Now, when people diversify out of the stock market and they put their money into real estate, that helps the real estate economy. Now, economic conditions, number 4, economic conditions will shift when economic conditions will shift when the stock market is affected. Okay. Now, what I mean by economic conditions is take a look at unemployment. Unemployment typically, when the stock market drops, unemployment typically goes up because big chip companies start to lay off, right? Like if companies like AT&T, Verizon, we get companies like Johnson & Johnson, Boeing, who's been getting beat up for the last 3 years. On stocks economically, they've taken bailouts. They're not even paying out dividends no more. We take companies like Walmart. We take companies like ExxonMobil. We take companies like Shamrock, the big dairy company. We take these big companies, right? These big blue chip stocks. And if they start laying off because stocks drop, that affects our economic conditions. That does affect the real estate market in a negative way. Because anytime unemployment goes up, real estate, residential, single-family real estate purchases tend to drop, at least in the median sector, right? That's the first sector that gets hit when economics are otherwise compromised. So long-term reductions in the stock market is even bad for real estate. So in spite of number 3 being a positive attribute for real estate, number 4, if it affects our economic conditions and unemployment goes up, it negatively affects real estate as well, okay? Now, it also affects it also affects construction and real estate because consumer spending goes down. And from experiences that most of us have had that have been in the market forever is that when housing goes down and consumer spending goes down, everything follows suit. Automobile spending goes down, furniture spending goes down, commodity spending goes down. Restaurants get affected because people aren't spending expendable money going out to eat and entertainment. So the entertainment, the travel, the leisure places that usually benefit from the economy doing really well, those go down. If you take a look back at 2008 when the economy was getting smashed, both the stock market and the real estate market, the leisure industry took a beating for like 3 years. And so you could pick up hotels for a very reasonable price. You could pick up investment properties like Airbnbs at that time for a very reasonable price. And so this is where people started getting greedy, and rightfully so. Investors got smart. They say, okay, it's time to buy, right? And what happens with non-sophisticated investors is they retract during that time. And when they retract during that time, they're waiting for the economy to come back. But once the economy comes back, everybody's in the market again. So I always tell people when the market contracts, it's time for you to go be greedy. Warren Buffett told me, right? It's in Warren Buffett's book. He said, look, when people are greedy, retract. When people retract, be greedy. And so go after it when the market is bad. And so when consumer spending is bad, it's a great time to buy real estate. But the real estate and people that own real estate, they just have to hover in it because it's those who have to sell and are over leveraged that otherwise get compromised under economic circumstances that are affected specifically by the stock market, at least in this video, right? Okay, now, fifth, last and not least, supply and demand dynamics, okay? This is the fifth effect of the stock market getting hit and how it affects our real estate market. Supply and demand dynamics. Real estate market will also depend on local factors such as supply and demand, housing inventory, and regional economics, right? So if we get affected and unemployment gets affected, supply and demand also gets affected, right? Because now all of a sudden there's a lot more supply on the market and the demand for it might be there, but if people aren't buying it and supply goes up, then builders want to sell. People in real estate, they want to sell because the immediate demand for it is on halt because of the scarcity mindset that most people have when there's uncertainty in the market. And when the stock market crashes and it stays down for a given amount of time and consumer confidence goes down, this is an exact correlation. Can you guys see how like number one affects number two? Number two affects number three. Number three affects number four. And then number four affects number five. And so if we go in and economics turn for a long duration of time, it's a one, then a two, then a three, then a four, then a five. Lay me down, and it affects all five of those sectors as the stock market gets affected long term. So we want to be careful when we get excited that the stock market goes down because our initial instinct is that, okay, stocks are down, real estate's up. But if it holds down too long, it affects real estate. And then if real estate gets affected too long, it affects the supply and demand. If it first affects our economic conditions, then it affects our supply and demand dynamics. And then when the supply and demand dynamics happens, now there's an absorption rate that takes a given amount of months or maybe even years, depending on how long it's affected. 2008 took years. COVID took months. And now we're sitting where interest rates are actually otherwise sitting compromised, inventory sitting for a little bit. I have a feeling the absorption rate is going to go a lot quicker right now because supply and demand, in spite of there being a supply and demand weighing against us where homes are sitting in the market right now, the demand for real estate and the lack thereof is more dominant than what is on the market currently. People, even though they're contracting financially, I will tell you guys, it's not because of the stock market this year. People are contracting right now is because it's an election year. And so if you guys go back to the Obama years, right after the 2008 recession, when Obama was in office, there was so much uncertainty in the market at that time. So much uncertainty in the real estate market because of the 2008 crash with Lehman Brothers going under, AGI going under, and these big companies going down, that there was so much insecurity in the consumer market that everybody was hyper-focusing on the election. And so it didn't matter if a Republican or a Democrat got in. As soon as the world knows and that uncertainty is off the plate, consumer spending goes back to normal or somewhat normal, right? And you watch it, as God is my witness, I promise you guys, right now, there is a retraction in consumer spending right now. There's uncertainty in the market, right? There's so much political stuff going on between the Democratic and Republican Party. They're like at odds with each other. And, you know, historically, we've seen time frames like this, but really what makes America great is the diversification in our legislators, in our legislation, and our presidency, because we live in one of the most sophisticated countries in the world. Now, is there corruption? Yes, there's corruption, but there's corruption everywhere. And as corrupt as it is, we still live in one of the best nations across the world to live in, do business in, raise families in, because of the freedom and flexibility that we actually have here. But you watch what happens after the November elections. Consumer spending and consumer confidence will go back up. Why? Because people hate change and they hate the unknown. And that's just the US American people. They hate uncertainty, they hate the unknown. But the second the unknown is known, whether it's good or bad, and they know, they just start spending again. So 2025 will be a great consumer spending year, because the elections will be over. The uncertainty of who's going to be the president is going to be gone. And so consumers will start spending again, at least the average median consumer. And then the wealthy, sophisticated people will be strategic in how they spend and what they spend on. And there'll be more to come in that regards as we move into the election and post-election. And I'll be bringing you guys, yes, that's right, all the information firsthand. Now, if you like this content, want more content just like this, click and subscribe to our YouTube channel, pound that thumbs up button, and ladies and gentlemen, go out there and never forget to compound your success. God bless you guys. Good night, and you guys all have a great one.